Welcome to The Two-Handed Economist. I'm John Diamond from Rice University's Baker Institute. This show gives you what a one-handed economist can't, both sides of the argument. We're not here to repeat sound bites. We're here to give you the full picture. Today is Wednesday, September 16th, and economic and budget issues are making headlines. This week's discussion will focus on the following issues. First, what does the latest data imply about a Fed rate cut at its next meeting? Second, is a government shutdown looming as the federal government's funding deadline approaches us on September 30th? And third, the budget process is broken and we need to fix it. Let's dig right in. On a recent show, we talked about the Fed's dilemma, how to balance sticky inflation with a softening economy. Well, the latest numbers just landed, and if anything, that dilemma has only gotten worse. The August jobs report showed a gain of just 22,000 jobs, and the unemployment rate ticked up to 4.3%. On top of that, the Bureau of Labor Statistics issued a big revision, cutting about 911,000 jobs from the prior year's totals. That tells us the labor market has been weaker than we thought.
New data show the U.S. job market was much weaker than initially reported for much of last year during President Biden's term and some of this year under President Trump. More than 900,000 fewer jobs were added in 2024 and 2025 than previously expected. The Bureau of Labor Statistics issues these revisions every year, but this year's change is the biggest revision on record. And it comes after President Trump fired the BLS commissioner last month after a weaker than expected monthly jobs report.
Meanwhile, inflation isn't cooperating. The Consumer Price Index rose 0.4% in August, keeping headline inflation at 2.9% year over year. With core inflation, that's prices excluding food and energy, running at about 3.1%. Producer prices offered a little bit of relief. The PPI actually fell 0.1% in August, though that's still up 2.6% compared with a year ago. And then there's the consumer. Retail sales surprised to the upside, rising 0.6% from July to August, with core sales, the kind the Fed watches closely, up 0.7%. On the surface, that looks like the economy is resilient, but the strength is not evenly spread across households. Spending is increasingly skewed towards high-income families, who still have cash cushions and stock market gains to lean on. Lower and middle-income households, meanwhile, are being squeezed harder by borrowing costs and diminishing savings. Put all that together, and the Fed is walking a tightrope. Inflation isn't fully tamed, but the labor market looks more fragile by the day. Cut rates too soon, and you risk reigniting price pressures. Hold them too high for too long, and you could tip a slowing jobs market into something worse. I expect a cautious 25 basis point cut this week, but I don't expect it to help much. Moving on, another government shutdown is looming as the federal government's funding runs out September 30th. That puts both parties under pressure to pass a continuing resolution, or a stopgap funding bill, to keep the lights on as federal agencies run out of legal spending authority. If Congress doesn't act, we're looking at another partial government shutdown. Federal employees would be furloughed, some public services would be disrupted, delayed payments to essential workers and government contractors would occur, and more. House Republicans released a continuing resolution on September 16th that would extend government funding through November 21st of 2025. This continuing resolution would extend current funding levels and add roughly $88 million for security funding for politicians and judges. Democrats oppose the continuing resolution and have vowed not to vote for it if it does not extend enhanced premium tax credits passed under ARPA and the Inflation Adjustment Act. Some Senate Republicans are pushing for a short-term extension of enhanced premium tax credits, while other Republicans argue that these provisions could be extended later in the year. What are these enhanced credits? They're government subsidies that help households who buy health insurance through the Affordable Care Act marketplace by paying their premiums. These were extended during the COVID era. The enhanced premium tax credits were originally passed under the Affordable Care Act. In response to the pandemic, the enhanced premium tax credits were temporarily expanded by the American Rescue Plan of 2021 and the Inflation Reduction Act. The expansion made households above 400% of the federal poverty line eligible for the premium tax credit and lowered the percentage of income that households are expected to contribute. Before ARPA, households with income between 100 to 400% of the federal poverty line would pay about 2% to 10% of income for coverage based on a sliding scale so that premiums increased as incomes increased. Households above 400% of the federal poverty line were ineligible. After ARPA, the cap on premiums was reduced to a range from 0 to 8.5%, and households above 400% of the federal poverty line were eligible to receive the premium tax credits. To put that in perspective, the federal poverty line for a single household is $15,060, and for a family of four, it's $31,200. So the cutoffs for the premium tax credit would be $60,240 for single households and $124,800 for a family of four without an extension of the permanent tax credits. Note that median household income was about $83,000 in 2024. Obviously, reducing subsidies for premium tax credits would increase the cost that households are required to pay, but extending the credits will increase spending through the tax code and the deficit. The Committee for a Responsible Federal Budget estimates that an extension for 10 years would cost $300 to $400 billion, depending on how broad the subsidy eligibility is. In terms of the overall cost over the next couple of quarters, CBO estimated that the 35-day partial government shutdown from December 22nd, 2018 to January 25th, 2019 reduced real U.S. GDP by about $11 billion over the following two quarters, including approximately $3 billion in permanent losses. So you get an idea of the trade-offs at hand. But let me be clear, this is about something more. This debate isn't solely about whether extending the enhanced premium tax credits is good or bad policy. What I'm pointing to is the process. That's the real lesson from this showdown fight, not just the policy at stake, but the broken system that decides it. When COVID hit in 2020, millions of Americans lost jobs, lost income, and in many cases lost health insurance. Washington responded with a series of emergency measures. One of them was the enhanced premium tax credits under the Affordable Care Act. At the time, these were framed as temporary relief. The American Rescue Plan made ACA subsidies more generous. Families at 150% of the poverty line suddenly paid zero towards benchmark premiums, and even middle-class households making well over 4 times the poverty level could get help, capped at 8.5% of income. The idea was simple. This was a pandemic emergency. It wasn't meant to last forever. But here's the thing about federal programs. Once people have them, it's very hard to take them away. By 2022, Democrats faced a political dilemma. the enhancements were set to expire. That would have meant double-digit premium hikes for millions of households right before an election. So the Inflation Reduction Act extended the subsidies, this time through 2025. Now here we are again with another budget deadline looming. Democrats are pushing not just for another extension, but for permanence. And this is how temporary policies become permanent policies and part of the entitlement state. It's not the first time this has happened. Farm subsidies were supposed to be emergency relief in the 1930s. Corporate tax breaks are often pitched as short-term stimulus and then routinely extended. Once a benefit is on the books, the political pain of taking it away often outweighs the cost of keeping it. This is what economists call the lock-in effect. And it's also a symptom of America's broken budget process. Instead of deliberate long-term planning, we get crisis-driven policymaking, where programs are born in emergencies, patched through short-term extensions, and eventually calcify into permanent spending. So when you hear lawmakers arguing about whether to extend the enhanced premium tax credits, it's about more than just health insurance. It's a case study in how Washington struggles to unwind temporary measures and how the budget process itself pushes us toward higher deficits and larger entitlements. What I'm pointing to is the process. These credits were created as temporary pandemic relief. Everyone understood they would expire when the crisis passed. But instead of revisiting the question in a thoughtful, deliberate way, weighing the cost, considering the offsets, and deciding whether to make them permanent, Congress has folded the issue into yet another budget showdown. So what's the way out of this endless cycle of shutdown threats, short-term extensions, and bad policy deals? We need a real fiscal anchor. One option is to determine the appropriate size of government as a share of the economy, say 20% of GDP, and force all federal spending to fit inside that box. That means if Congress wanted to expand subsidies or defense, it has to cut elsewhere. If revenues fall short, lawmakers must reprioritize instead of borrowing endlessly. Yes, there would have to be exceptions. If an emergency demands more, fine. But any breach comes with a supermajority vote and a plan to pay it back over time. This would end the gimmicks, the brinkmanship, and the habit of treating temporary programs as permanent entitlements without debate. It also would put the fight where it belongs, inside the cap, where we're forced to make real trade-offs. Other options include putting teeth back into pay-go rules, so new spending or tax breaks actually have to be paid for. End the shutdown brinkmanship with automatic continuing resolutions, or require real sunset reviews of temporary programs so that we debate them in daylight instead of sneaking them into last-minute deals. Without reforms like these, the cycle will repeat itself. Bigger deficits, more bad policy deals, and the risk of higher and higher inflation. So here's what to take away this week. First, the latest Fed data shows the Fed is boxed in. Inflation isn't fully under control, but the labor market is losing steam. The Fed is going to be forced to act. Second, another shutdown fight reveals the problem in our budget politics. Must-pass bills become nothing more than bargaining chips and political maneuvering instead of a way to just keep the government running. Third, the bigger lesson is clear. We don't just need to argue about premiums or spending levels. We need to fix the process. Until we reform how Washington budgets with anchors, real rules, and accountability, expect larger deficits, more bad policy, and higher risk for inflation. That's it for this week's episode of The Two-Handed Economist. Thanks for tuning in. The Two-Handed Economist is a production of the Baker Institute for Public Policy. recorded on the campus of Rice University in Houston, Texas. Production support was provided by Shannon Moriarty, Kevin Young, and Karina Zimmel. You can access show notes and other podcasts at bakerinstitute.org/podcast. If you like what you hear, leave us a review. It helps other listeners find the show. Until next time,